And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. I'm absolutely pleased to be here, and I'm pleased that you're here too. Today, we're going to be discussing the tax time bomb that you never saw coming. If you're a business owner, if you are a self-employed individual, if you are a person who maybe came from the old school where you saved a lot of the pre-tax money, this radio show is going to be very, very important to you, especially if you are sensitive about taxes and you're sensitive about things like survivorship benefits and legacy to your kids. Now, before we get started in today's show, I just want to encourage you. If maybe you're brand new to this radio show, well, aside from saying welcome to the program, I encourage you, go to our website, johnsonwim.com. There's just a wealth of information there. Anything from past radio shows to the YouTube videos that we record for YouTube every single week. There's also an opportunity for you to hunt around and find white papers that are touching on topics that you find to be financially intriguing and that you want to know more about. If you're a reader, I also encourage you, go to any of the major book resellers like Amazon, Barnes & Noble, and look up a copy of my book, The Capitalized Retirement. Something simple, straightforward, practical, easy to read, something that will help you better determine and see the things that you need to be prioritizing before you get to retirement, and even if you're in retirement, so that you can be successful and get what you want. A maximum income stream that will last the rest of your life. If that's what a successful retirement sounds like to you, then that book can be a wonderful complement in helping educate you on what you need to do today so you can have a more bountiful tomorrow. So what spurred this? Well, when we think about a business owner, and of course, I'm a business owner, maybe you are a business owner as well, we know that America is the place of the great promise, the great dream, that if we focus and we cause all of our time and our attention, we put all of our efforts towards something, it's not guaranteed that we're going to be successful, but the American dream is owning your own business, making your own way, being your own success story. And so many Americans have come to that point where they've said, you know what, I want to be my own boss. I want to be my own business owner. And some are still very small. They're sole proprietors. And some, well, they've gone on to expand their business and they have multiples of individuals that are working for them as their employees. Now, all of that is wonderful. But today I want to share with you a bit of a cautionary tale. You know, when you are a business owner, especially in the beginning, the only thing that you have is basically expenses, right? That's the way that it feels anyway. You don't have a lot of income coming in. You just have expenses. And you've got to do everything from pay the rent to buy the desk that the secretary's going to sit at. It's a real climb out of that hole. But then as things get started, as things really get moving, as you begin to become more profitable, now all of a sudden you realize that you will at some point come to this time in life, this area of business entrepreneurship where, well, guess what? You've got to make a decision. You've got to figure out, do you pay you or do you go ahead and pay someone else in order to buy something so that you can get a tax deduction? Now, let me just use a farmer as an example. Let's say that a farmer is maybe seeing some depreciation go away on one of his pieces of equipment, and he needs that depreciation so that he can put that towards gains or growth or returns or profit from his operation. He might choose to go out and buy a new combine. He might choose to go out and buy a new pickup truck or something of that nature so that he can now depreciate that item and put that against the gains that his business has made. many business owners, regardless of whether you're an electrician, you're a plumber, no matter really what the business is, you're going to be in a position where you can go ahead and you can buy things, make the business pay for those things, and then you can depreciate those dollars spent on that item out. And you can use that depreciation against the gains of your business, thereby reducing the amount of gains that are being reported to the IRS, thereby reducing the amount of taxes that you pay. Sounds simple, right? And in reality, it really is. In fact, I find that many CPAs, many tax preparers, will advise their clients to go and do this. Well, you need to buy another tractor trailer. You need to buy more equipment. You need to do this or do that in order to be able to get that item purchased to make an expense to get a deduction. But there is an alternative. There's an alternative that I would consider to be an even better and more profitable alternative. And that is not to pay the implement dealer. It's not to buy more equipment that you really probably don't need just to get the depreciation. The answer is to put money into pre-tax accounts. Now, we've talked on this show so many times that we have to be careful about the kind of money that we set aside. When we put money into things like 401ks, for instance, whether we're the boss or we are the employee, when we put money aside in a 403b, when we put money aside in a traditional IRA or a simple IRA or a 457 plan, all of those plans have one thing in common, and that is that they are pre-tax dollars. In some way, shape, or form, either A, we are getting a deduction for contributing money into that account, or we are simply just reducing the amount of income that we are reporting to the IRS for that particular year by the amount that we've contributed to that plan. So for instance, just as an example, if I make $75,000 and I've contributed $15,000 into my 401k, well, I'm not going to be reporting to the IRS that I made $75,000. Rather, I'm going to be reporting to the IRS that I only made $60,000. And do they know where the other $15,000 went? Of course they do. But the promise from them to us is that they won't be taxing it, at least not right now. Now, here's the thing. It's kind of nice. We can defer money into these accounts. We can essentially pay ourselves, and at the same time, we can get that tax deduction. We can reduce our income tax liability, and even though that's not exactly the same as depreciation on a building that we would build or a piece of equipment that we would buy, it is still a deduction so that we pay less in tax. Now, one of the things we have to be thinking about, however, is the fact that if the government has promised us that it's not going to tax the seed, does that mean that the government won't tax us at all? And the answer is absolutely not. In fact, the government is foaming at the mouth. The government is absolutely wanting to tax us, but they're being patient. They're wanting to tax the crop, not the seed, just the crop. Now, why would that be? Well, the reason is because, well, let's think about it. When we are contributing money, maybe we're putting $3,000 into our retirement savings per year. Maybe we're putting $5,000. Maybe we're putting more than that. Maybe we're doing $20,000 or $25,000. Maybe we're doing more because we've got some really big plans going on, such as a SEP IRA or maybe a 401k, and we're loading it up because of our age and because of a catch-up provision. But nevertheless, what's going to happen is down the road, the government is going to require someone to pay taxes on all of those dollars. So have you ever known at any time in life that there was a free lunch? I know I haven't, and I'm pretty certain you haven't either. The reality is at some point we are going to have to pay the piper. It just depends upon who's in office, what the tax law is at the time. There's going to be a lot of variables that are going to affect how taxable those dollars are to us when we get into retirement age. Now, here's the cautionary tale. As much as I understand that it's an attraction to be able to put money into the IRA, the 401k, the simple IRA, to create a tax deduction, to be able to create less income tax liability. My friends, at the far end of things, it's not always so worth it. You see, at some point, you will have to pay the piper. At some point, you will have to deal with a tremendous tax time bomb. Something that as those accounts that are taxable grow, they get bigger. Well, let's think about it. When you have $25,000 and you make a 10% return, $2,500, well, that's a good amount of return, but it's not terribly impressive. And yet, let's see, you get to a point where you have $2.5 million and you make a 10% return. That's $250,000. Man, that looks huge. And you see, that's the problem that so many successful business owners have. Those that are really good savers. And you don't necessarily have to be a business owner to have this problem. I just find that oftentimes business owners are more, well, they're more vulnerable for this area of a problem. They save and they save and they save, and they try to be diligent savers. And as they're saving, they're making good, wise financial investment decisions, putting money in the right place at the right time, and those accounts are growing, they're getting bigger. What's happening as they grow is the velocity of growth is getting larger and faster. And before you know it, you're going to be in a position where those accounts have literally grown out of hand. Now, we're coming up to our first break, and when we come back, we're going to be discussing what are the consequences. Like, is it really that big of a deal, Matthew, if I continue to focus all of my efforts on pre-tax? Well, I can't say for sure if it's going to be a problem for you, but let's discuss the aftermath of having so many of these dollars in pre-tax accounts, the effect that it's going to have on you, the effect it's going to have on your spouse, the effect that it's going to have on your children. And then I'll let you make that determination if it's something that you want to continue to focus on. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining us, welcome to today's program. Today we're talking about taxes. We're talking about saving money in a very particular type of retirement account, one that is pre-tax, and how this can turn into, unfortunately, a tax time bomb. You see, when we're younger, we are always encouraged to save. And if you're young and you're listening to this radio show, I encourage you to save. There's nothing wrong with saving pre-tax money. It's a very good kind of money because it will help you save in taxes. If you're not reporting all of the income that you're making because you're deferring money into a pre-tax 401k or IRA or something of that nature, that has its merits because, of course, it's now less money that you are reporting and paying taxes on for earned income, and you're saving for yourself. You're not just simply going out and buying another expensive thing with business money in order to be able to get depreciation or a tax deduction. You've learned to pay yourself instead of the implement dealer. You've learned to pay yourself instead of the supplier of that tool. But nevertheless, there are consequences to doing literally everything. And one of the things that we have to be so very careful of is to understand that, again, the government doesn't want to tax the seed. It's a very small thing. What the government is doing is waiting very patiently so that they can tax the crop. And just before we left off in the first half, we were discussing how as our dollars grow, as they compound, as they get bigger, and especially when they're involved in a market like what we're seeing right now and we're participating in, where the market seems to hit new world record highs every single week or every month. Well, it's exciting to see our money grow, but we have to be thinking about what's going to happen down the road. So the first thing that I want to bring to your attention is just a few common sense ideas, observations maybe. You see, the first thing is that even though it is very, very common for the average American to have most of their money saved in pre-tax accounts, whatever those may be, oftentimes there is a major misunderstanding of the same investor thinking that this account is going to make an okay place to build a new house from, or to buy a new car, or to be able to send a kid off to college. Now, even though there is nothing inherently wrong with taking money out of the IRA or out of the 401k to put your kid through college or to buy the new car or to build the new home, the reality is that that's a lump sum withdrawal. And unfortunately, in my opinion, I find that oftentimes IRAs and pre-tax accounts in general don't make good lump sum withdrawals. They don't make good lump sum accounts. You see, when you take out $100,000, if you want to net $100,000, you may be taking out $125,000. Why? Well, because you always have to account for the taxes that you're going to be paying to the federal, and depending upon the state that you live in, maybe the state too. And so as a result, I try to coach my clients that pre-tax accounts make good income type accounts, where you're taking the money out over the course of time. You've turned it into income, and this way you're stretching those payments out over the course of time. You're able to pay taxes over the course of time instead of getting just blasted with taxes all in one shot. Now, the second thing that we want to be thinking about is the fact that when it comes to employer plans like 401ks and 403bs, you may have all but retired, or you've come to a place of retirement, and now you're thinking, well, it's done so well for me during the accumulation stage that it's going to continue to do well for me on the distribution stage. However, I would caution you that employer plans are not really designed for distributions. In fact, there's very few things about the various different instruments or investments or the funds that employers would offer their employee through the 401k that would be attractive to an up-and-coming retiree. Part of the reason is because, well, 401ks are designed for growth. They're not designed for income. They're not designed for safety and security of principal. And so this is one of the major things that causes an ex-employee to roll their 401k out of that more risky growth-oriented account and into something where they can sleep at night, something that will afford them the peace of mind to know that their principal is going to be safer. But here's a big component. When we have money in a 401k, an employer plan, and we go to withdraw money from that plan, remember that there's going to be a mandatory 20% federal withholding on that dollar. So every dollar that we take as a withdrawal from that 401k, we're simply not going to get $1. We're only going to get 80 cents. And so this is the reason why so many employees will roll money from employer plans into traditional IRAs. So guess what? There is no mandatory withholding. This way, if you take out $1 from your IRA, you'll get $1. Now, if you choose to do withholding, which is, I think, the smart thing to do so you don't pay a penalty, being able to do a little bit of withholding from that withdrawal is advisable. But here's the thing. Let's be thinking about, as we age, do we want every single dollar in retirement to be a taxable dollar? If the answer is no, then this leads me to one of my cautions. Please take a look at what you're saving, the kind of money that you're saving. Pay attention to what type of money it is. If it's all pre-tax money and you haven't diversified into Roth IRAs, if you have not diversified into post-tax non-qualified accounts, I encourage you, explore them, learn about them, talk to a financial advisor, a fiduciary, someone who can begin to help you better understand how having a variety of different types of money can help you. And you see, the reason that this is so important is let's go beyond your working. Let's get into retirement. What happens to the person who's got that $1.5 million, that $2 million that's sitting in that IRA? Well, when you reach the age of 73, we know at that point, that's when the government now considers your retirement savings to be an open target. This is where the government is going to put its crosshairs on that money, and it's going to force you. It's not going to ask, it's not going to suggest, it's going to force for you to take that money from that taxable account. Why is that? Well, because they want to tax you, and they want to tax that crop. Here's the thing. As you age, as you get older, as you get up there in the years, from 73 to 74 to 75, and for the rest of your living life, the amount of required RMD is going to continue to go up. The factor, the percentage that they force you to take from that account is going to continue to increase and get bigger and bigger. And why? Because their worst nightmare is you dying without paying taxes. But let's take it one step further. Let's say that you've died. Now, we should know, if we don't, that if we have properly prepared our beneficiary designations on our pre-tax accounts, if we are married, if we have a surviving spouse, that surviving spouse should likely be the primary beneficiary of that account. And when we die, our IRA will become theirs. But you know what else is going to change? Their tax status. Because they're no longer going to be a joint filer. And if you know anything about tax brackets, if you know anything about the various different ways that we can file taxes, we know that you can file taxes jointly, but we also know you can file taxes singly. And guess what? You don't get to make as much income as a single tax filer before the tax brackets push you even higher. And what this means for you is if you've got a lot of pre-tax money that you've saved, you've worked hard to build and to grow, but you die, and now your surviving spouse receives that money, becomes the IRA owner, she or he will be responsible for taking that same RMD and now potentially paying a lot more tax on that money. You see, giving away more to the IRS, that could be in your future if you don't pay attention today what kind of money you're saving. Now, let's take it one step further. If I haven't appealed to your sense of sensibility, then I want to have you think about your kids and your grandkids. And this is the only question I'm going to ask. Is it going to be better for you to give, say, a taxable dollar to your kids and grandkids when you die as a legacy and inheritance? Or would it be better for you to give them a tax-free dollar? Now, it doesn't take rocket science to understand that a tax-free dollar is always more advisable. A tax-free dollar is always better. And granted, you saved this money for you. You saved it for your enjoyment, for your own retirement, to do whatever you want with whomever you want for however long you want. This is your money to spend on yourself. You've worked hard for it. But if you're like so many of my other clients, you want to make certain you will leave a legacy. And my only caution to you, friend, is realize that the government doesn't care. If they can't tax you, they will tax your spouse. If they can't tax your spouse, they will tax your children and your grandchildren. And even though I'm optimistic that we have gotten some really, really good tax code that's going to keep life pretty simple, and we're going to pay a lot less in tax overall for maybe the next decade or so, we have to think further than that ahead. We've got to be thinking about the next generation. What will happen if these dollars of ours are never dealt with. So when's the last time that you had a true, serious conversation with your CPA, with your tax preparer, with your financial advisor, your fiduciary? If you don't have one, I encourage you to get one and sit down and look at the long-term side effects of not doing Roth conversions. Is it something you have to do? No, not at all. Is it something that every investor should do? Probably not. But you could be the case in which, by doing Roth conversions, taking or even spending some of the money today on yourself and your spouse, you would actually be helping yourself in the future, helping your family, helping your legacy. Taking a little bit of initiative today can save your family all sorts of taxes tomorrow. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.